Joining me is Jonathan Booth, who is Chief Executive Officer of Booth Laird. Jonathan is a value investor, and I'm really excited to have him here to learn about his background and investment approach. Jonathan, perhaps we could just start by having you tell us about how you first became interested in value investing and what path you've taken since.
Sure, and thank you for having me on. My route is a little more circuitous than most. I actually started in accounting. I got my bachelor's degree and master's degree in accounting, Louisiana State University. But while I was in school, and actually starting when I was 11, my uncle started buying me stock, and it was in McDonald's actually. So for every birthday and for every Christmas, he'd buy me stock in McDonald's, and he would get my grandmother and my other family members to buy me stock in McDonald's. And when I was in high school, and he would explain to me why this was a great investment. And then when I got in high school, somehow I'd accumulated $800, and I put all of that into McDonald's stock. So that really got me interested, although I didn't really know what I was doing at the time. And then he was a big fan of Warren Buffett. So, of course, I became a big fan of Warren Buffett. And then when I was in college, he took me to the Berkshire Hathaway annual stockholders meeting, which was a wonderful experience and a great education. I don't know how many years we have left with Charlie and Munger, so if anyone hasn't gone yet, I highly encourage it. I've been 4 times now. But that really got me interested, and I started reading the books about Buffett, The Making of American Capitalist, The Warren Buffett Way, The Essays of Warren Buffett, and then I moved on to Common Stocks and Uncommon Profits by Philip Fisher. And the more I read, the more interesting it became. And then when I went to go work, I got my accounting degree, my bachelor's, my master's degree, and I went to go work for Ernst & Young in public accounting. And I got to see the inside of companies. Of course, I was looking at their financial statements, and you had to understand the industry that you're auditing. Otherwise, you wouldn't really understand the financials you're looking at. So the more I audited, the more, ironically, it got me interested in investing. And then after about 3 years of audit, I decided I really want to build the next Berkshire Hathaway, which I'm sure every value investor who has their own fund wants to do that. But that's what got me started on this path.
Tell us a little bit about the genesis of your firm. You have a partner, I believe, there. How did you guys decide to kind of go this way, and what are some of the principles that you live by, if you will?
Sure. My partner is Kevin Laird. We actually met while we were both working for KPMG, and within 7 months we decided of meeting each other. We decided we wanted to build a company together. At the time, we didn't really know what we wanted to do, but we realized we had very similar approach to business and investing. Now, he didn't quite have the background I had with investing, as far as, an uncle that walked him through it and all that and took him to the Berkshire Hathaway meeting. But he was still very interested and had a wonderful mind for business. And that was one thing we both recognized in one another, is we had an entrepreneur mindset, a business mentality, and that helped us. That we determined was key in analyzing stocks. And so I guess it was 2008 was when we started the partnership. We decided, we want to start investing in stocks, and we want to do this for other people. Obviously, we didn't have any direct experience. Neither one of us ever worked for another fund or anything like that. And it was a very steep learning curve the first few years. But our approach is very much a value investor approach, which has really been honed over time. But we wanted to buy quality companies at a margin of safety, at a discount to their valuation. And from the beginning, we determined our own valuations. We've gotten better over time, but for the most part, we use a discounted cash flow analysis. Some industries require a different approach, but our philosophy it's really been shaped, and we can really describe it as we focus on out-of-favor stocks, which we describe as stocks that are mispriced due to uncertainty or fear, misunderstanding or obscurity. And then we do a lot of due diligence to overcome those hurdles and we invest only if there's a significant discount to our valuation. And we only want to focus on those investments that we have a lot of conviction in. So we limit ourselves purposefully to our 10 to 15 best ideas. So if we have 15 investments and we find a new one, well, we have to make a tough decision. We won't allow ourselves to go over that. And we found that really fits with our personality. We've heard, everyone has a different opinion on how many stocks you should have, how diversified you should be. But to me, it comes down to what's your personality, what are you comfortable with, and to us, it just makes a lot more sense to focus only on those stocks that you've done your homework, that you know really well, that you have a strong conviction in. And, you're not going to have 30 stocks, in my opinion, that you feel that convicted about. Your top 10 are going to be better than your second 10, and those are going to be better than your next 10. So I'd rather just put more money into my top 10. And we've never, just like Charlie and Munger, we've never really had, Charlie and Munger, Warren and Charlie, we've never had a disagreement between the two of us. We just have this, we're really a great partnership because we have very similar outlook on investing and business and all that sort of stuff.
I think that's a really key point that you just made regarding being comfortable and essentially structuring the portfolio in a way that you can sustain through tough times. And I've talked to managers who like to have 10 stocks or even fewer, and then others who go to 30 because they don't like the volatility of a smaller portfolio. Obviously, as you go higher and have more holdings, it gets tougher and tougher to actually outperform an index. But maybe just talk to us a little bit about kind of how you figured out what that optimal number was for you guys, and maybe tell us about the experience of 2008, where I'm sure you kind of had to go back and really think about your comfort level with such a strategy.
Sure. We developed that number kind of through trial and error. We found that the stocks that we had the least amount of conviction in, we were only putting 0.5%, 1% into, and we didn't do a lot of research on them. And when things didn't work out quickly, we weren't really convicted, so we sold quickly too, and we usually lost money on those. It was a small percentage of our portfolio. It didn't impact us greatly, but we never really felt comfortable with that. And if we're going to do a lot of research on something, then I don't want to do all that work and then only put 1% of my portfolio into it. Our largest holding right now, I believe, is over 20% of our portfolio. The second, we have our top 4 holdings are about 50%. So if we're going to do that much work on something, we want it to be meaningful. So that's what we figured out over time. And so part of it's driven with the minimum we want in a single investment is 6% of our portfolio. If we don't feel strong enough about it to put 6% into one investment, then we shouldn't do it. And of course, there's 100 divided by 6 is only so much, and we like having a nice level of cash. The lowest amount of cash we want is 10% of our portfolio to take advantage of opportunities. In a market like this, we're very comfortable holding 20 to 30% cash, where it's very difficult to find a lot of really cheap stocks right now. We were at 14 investments about a year ago. Right now we're down to 9 because we've sold all stocks and haven't replaced them because just the market's just so expensive. It's just hard to find those really cheap ones. Now, 2008, we actually started the fund in 2008, and it was a tough time to start, but at least we were able to pick our spots. So we weren't fully invested. By the time we started to the end of the year, the market was down 34%. But we benefited from not being fully invested at the time. So we were able to pick our spots better, and we were actually up for the year. Well, we didn't invest all of our cash. Our investments were up about 8%, but we still had a lot of cash on the side. So I think as a whole, we were up about 4%.
Great. You mentioned your highest conviction investment right now might be around 20% of the portfolio. What kinds of features does a company or an idea need to have to give you comfort to make that kind of allocation to it, perhaps both in terms of valuation as well as maybe the balance sheet features or the features of the business itself?
Well, one of the primary things we look for is an industry that we can understand. So there's a lot of industries that it'd be hard for us to ever have that level of conviction. Retail, for instance. Retail is not an industry that I would ever really feel comfortable putting 20% in, at least at this point. Oil and gas is an industry we've never really brought into our circle of competence. Not that we won't ever do that, but so the industry is important. And then within the industry, it has to be a company that we think has some sort of durable competitive advantage. You hear that a lot in value investing circles, but something that allows it to maintain and grow market share over time. And I prefer it's not overly leveraged, but if they have the cash flows to support it, I can get comfortable with that. But too much debt, if we're talking debt to total capital of 70% or higher, then I'm probably not going to feel comfortable. Not that that's a hard and fast rule, but I'm not going to feel comfortable putting 20% of my portfolio in a stock that's that highly leveraged. But the biggest factor comes down to valuation. The first thing we look at is the downside risk. What is the risk that we will permanently lose capital? Because our number one goal to our investors is preservation of capital. We don't want to lose them money. So that's the first thing we look at, what's the downside? And then we look at the upside. So we've looked at stocks where the upside was 50%, which is decent, especially in this market. But the downside was also 50%. And we couldn't really tell you, with any degree of conviction, the probability of the upside occurring versus the downside. So to us, it was almost a coin flip, so that's not worth it. Our 20% investment is actually up significantly. That one was basically priced as though it was going to go bankrupt, and it wasn't even remotely close to going bankrupt. And it's just the market just didn't really understand the company, and so we were happy to take advantage of that. That's one thing looking for out-of-favor stocks, you're really looking for beaten-down stocks where worst-case scenarios, very, very poor scenarios are priced into the stock. And so your risk of permanent loss of capital is so low that why would you not put 15, 20% in there if the downside is close to 0% and the upside's 100%.
Are you at liberty to discuss that company at all, or?
Oh, sure. That one is Hartford Group, which we've been with them for about a year now. But we bought their TARP warrants about 6 or 7 months ago. That stock is going through a transition period, which drives away a lot of investors because they don't like the uncertainty. People hear Hartford Group and they think of life insurance. And I'm not a big fan of life insurance, but I am a huge fan of property and casualty insurance. That's my favorite industry, probably of all. And their life insurance business had gotten them into trouble. It required them to get TARP money. All their executives were basically fired and replaced with outsiders. So they really had to think hard about themselves. And John Paulson was really pushing them to spin off the P&C business from the life business, which he presented a great case, and it seemed like such the obvious thing to do that management surely would do it. There was new management. They'd only been there a year or two, so they didn't have a lot of stake in the old way of doing things. I mean, they were willing to shake things up. So we invested, and about 2 weeks after we invested, they announced that they were going to basically split up the business, but they were going to do it a little bit differently. They were going to sell the life insurance business, put all the annuity into runoff, and just focus on the property and casualty, which was a smaller part of the business, but more well run, had some competitive advantages, etc. The market was spooked by that because I didn't understand it, so the stock dropped, even though we felt, even before the drop, it was significantly undervalued at less than 50% of book value. They got all the way down to about 30% of book value. That's when we looked at the TARP warrants. The TARP warrants at the time, of course, they got those as a result of the government giving them money as part of the TARP program, and the government getting warrants as a result, and then sold those to the general public. Those warrants didn't expire until 2019, and at the time, the stock was selling for about $16, and the warrants were priced as though that stock would only appreciate about 17% in the next 7 years, which would, when the stock was priced as though it was going to go bankrupt at the time, which wasn't going to happen, and then those warrants were priced so incredibly cheaply, it seemed like a no-brainer. So we put as much cash into it as we could at the time. We basically got below our 10% threshold. We got down to 5% cash to take advantage of that. Since then, the TARP warrants up about, I want to say 75, 80%. This was July when we bought it. So it was about 8 months, up about 75, 80%. And the stock's up about 50% since then. So we've grown. We've gotten a lot of new investor money since then, but so we didn't put more into it. It was 20% at the time, but it grew with our new money, so it's still 20%. We still think it's significantly undervalued, even after the strong run-up, because right now it's only about 50% book value. Conservatively, it's worth 75% book value, probably closer to book value. So.
And in terms of any strategic events or catalysts, do you see any of that actually materializing?
Well, they did. They've had a number of those already where they sold the life insurance business. The big overhang now is this annuity block. That's what got them into trouble to begin with, and they significantly hedged it. Berkshire just bought another company in similar position, sold that risk to Berkshire, and they didn't sell. They got Berkshire they paid Berkshire to take it off their hands, and that's if Hartford were to do that, then I think that would be a very strong catalyst, because that's the only really overhang left suppressing the stock price as much. Now, I think those annuities are pretty strongly hedged, so the risk that those annuities will result in the company losing 50% of book value, which is what it's priced at right now, I think that's extremely low. But that would be a very strong catalyst. And they're actively looking for ways to unload that exposure, other than just hedging it. And such as they offered to buy out some of these annuity holders. That usually has about I think a 20% success rate. So that's a strong catalyst. I don't know the timing. It could be tomorrow, it could be a year from now, but that would be a pretty strong catalyst.
Interesting. Now, you mentioned that property and casualty insurance is one of your favorite industries. Could you tell us why and how you go about analyzing those types of companies?
Well, property and casualty is my favorite, probably because my introduction to value investing was from Warren Buffett, really. And I'm reading all his stuff and his annual letters, and he gives such a great education on property and casualty insurance, the benefits of float, all these sorts of things. So that got me interested in it, and so I just dove in and started analyzing companies, and the more, it's just, I think I've analyzed so many companies in that industry, it just makes so much sense to me now. What I look for is a company, just like what Buffett outlines in his annual letters almost every year, a company with pricing discipline that will walk away from a policy that's not priced to make a profit. You'd be surprising number of companies that are more than happy to lose money on the underwriting because they think they can make up the profit by investing that money. Well, they're only investing, even a few years ago when interest rates are higher, they're only getting 4% a year because they're not, going out and investing in risky things. They're putting it into bonds and things of this nature. And as those bonds mature and interest rates are lower now, they're finding that, they can't keep this up if they want to make money. So that's causing prices, underwriting to get a little more disciplined across the market. But we like companies that are always disciplined in their underwriting. W.R. Berkley is a company that we've been invested in since either 2009 or 2010. William Berkley is their founder and chairman. I think he gave up CEO duties to his son, but just listening to William Berkley on the quarterly conference calls is such a wonderful education in the insurance business. He's been doing it since the 60s, and routinely they have a combined ratio, which the combined ratio measures the profitability of your underwriting. So if your combined ratio is 100%, that means for every dollar of premium you brought in, you spent $1 in the cost to underwrite as well as to pay the claims, pays the salaries of the people, that sort of thing. So what you want is a company that has a combined ratio below 100%. The lower the better. And they're routinely 90, 95%, when the market average is about 110%. So, that's a wonderful advantage. And like Buffett explains in his letters, that means that that's free float. In fact, that's float that you're getting paid to hold because you get those premiums in now, and you don't have to pay those claims out until later, if at all. And in the meantime, you get to invest that money. So it's free float, and they're making 3, 4, 5% investing it. So that's the sort of thing. We like to listen to the CEO talk. I'll read a lot of articles on different insurance companies and interviewing the CEO and whoever, and I just look for those keywords, the pricing discipline, and I'll look at their combined ratio and just look to see if their book value. To me, insurance, the financing industry is really the only industry where book value matters a whole lot in terms of determining the value of the company. And if you have a really well-run property and casualty insurance company, then they're probably worth 1.5 to 2 times book value conservatively. So if they're selling for less than book value, then we get pretty excited. And so that's generally what I look for. Is I look at the combined ratio, and then I'll look at the price to book value to see if there's something here.
We actually had Tom Gaynor do a keynote Q&A session at the Best Ideas conference recently at valueconferences.com, and I believe Markel, at least in early 2013, traded around book value. Have you looked at Markel and maybe more broadly, based on your research, what are some of the companies that you respect for their underwriting discipline?
I have not looked at Markel. I've just wrote their name down. I'm going to look at them. Some companies, with W.R. Berkley I mentioned, AmeriSafe, which they're actually based here in Louisiana, and they're actually going to be speaking at this equity conference we're going to be putting on. They are in the workers' comp insurance business, a niche of the property and casualty insurance business, and they focus on hazardous occupations. So you really have to understand the risk there if you're going to write that profitably. And they are extremely price disciplined, and there are years when their combined ratio is in the mid-80s, which is amazing. Of course, Berkshire, as far as insurance goes, they do a wonderful job. We're invested in a reinsurance company that reinsures property and casualty, and about half of their business is property and casualty. And it's called AHL Group, Aspen Insurance Holding. They're actually based out of, I believe, Bermuda. They're another one of these that Well, they were selling for about 0.6, 0.7 times book value, and they were just listening to their earnings calls and looking at the combined ratio. They definitely are the type of management we want to be in bed with. There's another one that I've added to my list, hoping it will drop. I believe it's Lancashire. It's in London. I don't know how to pronounce that, but Lancashire Holdings, ticker symbol LRE, and I'm just waiting for their stock price to drop, because just listening to their management speak, it's definitely the sort of management that we like.
Jonathan, you mentioned the conference that's coming up, and I just want to highlight that for our listeners. It's the Booth Laird Equity Conference hosted by LSU on April the 12th. Maybe just tell us a little bit about the conference and why some of our subscribers and listeners should make the trip out.
Sure. The Booth Laird Equity Conference, hosted by LSU, is the first one of its kind in Baton Rouge, Louisiana, and there's one in New Orleans every year, but outside of that, there really aren't any other investment conferences within a 400-mile radius. The investment community in Baton Rouge is growing, and we felt it was time that we had something like this. And there are some publicly traded companies in the area that they're liquid enough that just about anybody can take advantage of them, but they're small enough where people may not know about them. So we partnered with LSU to put on this event. We're going to be having 4 publicly traded companies come and speak. One is based here in Baton Rouge, Edging Group. They just went public last year. They deal in specialty pipes, mainly to oil and gas industry. They have AmeriSafe that I just mentioned. They're out of DeRidder, Louisiana, and they focus on the hazardous occupation workers' comp insurance industry. America's Car Mart is a company that we've been invested in since 2011, done very well with them. They're the leader in the buy here, pay here niche of the car dealership market. And they cater to subprime lenders. It's called buy here, pay here because you actually go to the car lot every 2 weeks as you get your paycheck to actually pay your note. And they have a wonderfully run business. Their metrics dominate the industry. And they're going to be speaking there from Arkansas. And then we have Encore Wire. They're out of Texas, and they focus on the wire and cable industry. They're going to be, they're the largest one. They have about 650, 700 million market cap. The lowest is about 350 million. And then in addition to that, we're going to have 2 LSU students also present, each on their best value investment opportunity at the time. There's a professor that we're working with, Dr. Kilborn. He teaches a class on really value investing or distressed investing. And he's been working with these students on these ideas. So we're really excited to hear what they come up with. And then I'm also going to present on my best idea at the time. So we think it will be a great event. Hopefully this will be the first of many. The Dean of the College of Business at LSU is fully in support of that. Based on the people I've talked to, there's a lot of strong interest. So we're really looking forward to it. It'll be 8:30 to 12 in the morning at LSU, the brand new business education complex. And hopefully people will be able to make it.
And where can folks get more information on the event, perhaps online?
Yeah, we added a page to our website. If they go to www.boothlaird.com, Booth Laird is BOOTHLAIRD. Go there, and then you can see on the top, it'll say Equity Conference is one of the tabs. You can just click on that, and that will provide all the information.
Wonderful. And is that an annual event that you guys put on?
Well, it's the first year that we're doing it, but we're hoping to make it an annual event. And we have LSU support to do that. So hopefully it will be the first of many.
Great. Well, good luck with it. It's always nice to see value investing get spread around and then kind of get more and more folks on board.
Yeah, absolutely.
Maybe just as we finish up, Jonathan, could you just talk about one or two books that perhaps have influenced your own path as an investor that you might recommend to others that are looking to hone their value investing skills?
Where do I start? I've read so many books that have been so beneficial. Well, there's the obvious, The Intelligent Investor, and that was really the first. I failed to mention that one earlier, but The Intelligent Investor by Benjamin Graham, really, if you read that and it makes sense to you, then value investing is for you. And I think that will really start people down the right path. Common Stock and Uncommon Profits, I think, is the next book people should read after that, which really goes more into the qualitative aspects of understanding business. And actually, The Warren Buffett Way, written in the 80s, I found to be a great book in helping to better understand value investing, but also how to value a business, because at the time I really didn't have any idea how to value a business. And so those are the three that I really started with that got me started down this path. So I would highly recommend those three.
Wonderful. Well, with that, Jonathan, I want to thank you so much for your time and for telling us a little bit about your background and investment approach.
Well, thank you very much. I appreciate it.